Hello, I hope you're doing well. I'm here with you for the third session of our price action course. This is a course that's entirely free of charge, and it makes you fully self-sufficient and independent of all those various courses and packages sold on the market that charge you unreasonably high and exorbitant fees for them. Well, the vast majority of you have realized by now that people in the online trading community are trying to push repetitive patterns on you as technical and price action packages and courses in various styles, simply rebranding and renaming the patterns. And in the end, even if you take 100 courses in a row with them, you won't get any tangible or consistent results. Because in practice, it's a completely unsuccessful and flawed process that none of them have actually been able to achieve any tangible results from themselves, and they have no financial statements to show you. They just put different names on it, so you'll think the previous course you saw definitely won't work, and that the brand new course they're offering will be effective and fruitful for you. So they can extract as much additional money out of you in any way they possibly can. But in this course, if this is your first time joining at session 3, I recommend you go back and watch from session 1. We have a different approach, a different perspective on the chart that practically makes you independent of any other course forever. This means you will gain a comprehensive and deep understanding of analysis based on historical and current price movements, and you'll get the complete and essential foundation of technical analysis and price action knowledge throughout this entire course. The rest goes into a variety of other important matters that you can follow in the other sections we actively develop and manage in our group, and the other tutorials we regularly upload and share on our channel. And you'll see that the world of crypto, at least where we're active, does not simply require only technical knowledge. Meaning, technical knowledge is only 10% of what you need to know in this market. And I'm not saying the rest is just psychology and capital management. No, the rest comes down to fundamental topics, equally to risk management and capital management. And fundamental analysis is also very relevant in the crypto market for you to have a profitable strategy. Technical analysis alone won't give you a strategy, my friend. Okay, let's move on with our lesson. In the previous session, we discussed in detail that we need to have a highly effective and thorough analysis and an entry point, so that after we enter a trade, the decisions of other traders will then validate and reinforce the decision we made. Meaning, we learn to throw away extra triggers, not to look for candlestick patterns on our chart, like needing to see an engulfing pattern to enter a trade or anything else. And once we find our reasonable level, we go and set our order in that range. Now, how this trend takes shape and how we get to the point where we can accurately find that range, you'll learn as we go through this course. But in this session, we want to understand why we're even doing analysis in the first place. So you might be wondering, what's the point of doing analysis for us? Well, performing a thorough analysis, guys, really helps us understand exactly where the historical prices come from. So analysis has two parts for us: analyzing the chart's history. Some of my really ignorant friends, that's the nicest way I can put it, who want to come up with something brand new. Saying the chart's past doesn't matter to us at all, that's just not true. Or others say the opposite, that the past shows us exactly what's going to happen in the future. Both are wrong, guys. Our analysis needs to tell us where the price came from. So it covers the chart's past and lets us analyze the current state and the chart's future. So our analysis has two distinct parts: exactly where the prices come from and where it is most likely going to be moving next in the near future. If I can do a correct analysis, does that make me a winning trader? No. You've only just become an analyst. So the first part of our lesson turns you into a good analyst. So you can tell your friends, hey, I think Bitcoin is moving from here to there. And they'll say, wow, nice. He analyzes so well. Just like many people online who are actually great analysts, guys, but they aren't good traders. Many of these creators or their professional staff might have valuable insights where they predict a specific coin will rise or fall, and it actually happens, but they don't personally profit from it, and neither do you as their loyal audience. Why is that the case? Because they're just not good traders. Because just being able to analyze well doesn't automatically mean I'll get results. Now, I'm talking to you about analysis. So you understand that analyzing is completely separate from trading. For now, we're just learning how to become an analyst. Okay, support and resistance. The very first fundamental concept you absolutely need to know when beginning your journey of learning price action or technical analysis is the essential idea of support and resistance. So in this comprehensive course, we aren't going to begin right at the very basic level and teach you what a simple candle is. In this session, we're going to discuss the concepts of support and resistance, but a bit later on, we will also cover a detailed candle-by-candle technical analysis for anyone who might not know the basics yet, though I honestly doubt many of you are in that position. If you're completely new to the world of trading and don't even know what a bullish or bearish candle is yet, and you want to learn everything from zero, you'll be able to pick everything up quite easily in just a few sessions when we do our detailed candle-by-candle market analysis. For now, we're talking about support and resistance. My point is completely separate from just drawing a line on a chart and telling you this is support, this is resistance. I want you to fully understand it, to feel it in your bones. How support and resistance actually come to be. Support and resistance levels are created based on trader behavior, and these levels are points on the chart that block the price's path. I didn't say these levels are where the price direction changes. I didn't say resistance is where the price hits and then crashes. I'm not saying support is where the price hits and then moves upward. I'm saying it's a zone or a level that blocks the price's path. The concept of blocking can have two distinct interpretations. Either I reach a point of resistance and range, or my movement slows down and then I break through it, or I reach a resistance and pause, or my movement slows down and I completely reverse direction. Meaning a resistance isn't necessarily going to hold forever. I call a level resistance if it either slows down or stops the price movement. Okay. Slow means I go up, range, and then break through. When I say stopped, it basically means I go up and my upward path completely turns around and reverses, and I start to go downward. And a support level is a specific zone where the price movement either significantly slows down or stops entirely within that particular zone. The downward price movement at support either slows down or stops. How does a support and resistance come to be? First, let's look at it from a social perspective. And let me use something like the dollar as an example. For instance, consider a situation where an individual investor buys the dollar at 60,000 tomans on the open market, and then the dollar exchange rate eventually climbs up to 60 or even 70,000 tomans. This person sees the 70,000 toman range, meaning they're 10,000 tomans in profit. They see the 70,000 range, and the price moves back down. And currently, the dollar has reached, say, the 65,000 toman range. As someone who originally purchased their position at 60,000 and saw the 70,000 range once and decided not to sell off, if the price drops back to 61,000, the very next time that it hits 70,000, you'll likely say, okay, maybe the price will move down from this area again. And your subconscious tells you that you completely missed out on a prime opportunity to sell in this range once. You were 10,000 tomans in profit once, and the price moved down until you only had 1,000 tomans in profit. So the next time the price reaches that level, a feeling tells you, hey, I'd better get out in this range because I missed it last time. And it's this mindset in us, in you and me as traders, that creates a resistance or support level. On the flip side, there might be a number of different people who wanted to buy dollars at the 60,000 toman level, or completely missed their chance to buy in that range and then watched as the price quickly hit 70. The next time the price hits the 60,000 toman level, they'll see it as a zone that has buying value for them. And this collective mindset of us traders being buyers at 60,000 tomans, forms a support level for the dollar. If you remember, we had a definition in the previous session where we said the price increases up to a certain point and decreases down to a certain point. Our very first definition of exactly how high the price goes was that the price goes up, up, and up until either there is absolutely no more demand left or there is so much new supply entering the market that it covers all the existing demand. This means that supply and demand balance each other out perfectly in that specific resistance zone, and that delicate balancing act creates a solid resistance level for us to watch. Wherever such a thing happens once, meaning the price was going up and reached a point where supply and demand equalized, or a pause occurred, or a trend reversal happened, from then on it becomes resistance for me. Based on our own definition, we're moving forward step by step, guys. And wherever the price is decreasing, we asked, how low does the price go? It continues to drop further and further down until either the available supply has been completely exhausted or a sufficient amount of new demand finally enters the market flow to cover all of that supply. For instance, the dollar price went up to 70,000 tomans. Why does it go to 70? Because at 70, either there are no more buyers or enough sellers have entered the market to change the trend. Once this happens, the next time 70,000 tomans, for someone like me who didn't sell in that range before, becomes a level where I'd like to at least take some profit this time. If most people in this range just take some profit and expectations are still for price growth, a pause occurs in the resistance zone because a small amount of profit taking is happening. But if most people's view is that the price is going to drop, a trend reversal occurs, and here a halt in the upward trend happens. Okay, so the reason I told you earlier that the price either pauses at the resistance level or stops and reverses was exactly this. I'll give you another definition of the resistance level. At the resistance level, traders have no incentive to buy at higher prices, and demand has come to a halt. Meaning an urgency, if you remember, I gave you reasons regarding supply and demand. I said just because, for example, they ask someone what determines the price, supply and demand, this person knows nothing because supply and demand themselves have a set of components that cause them to be created. Meaning what changes the price is the order flow, as we said in the previous session. And it's the trader's decisions that change the order flow. These traders' decisions are predictable for us in situations where they get caught in urgency, caught in desperation. Well, he says, where does resistance happen? A place where there's no longer any urgency to enter a long position. If Bitcoin becomes, for example, I'm saying, Bitcoin reached $70,000 and moved back down again. Not many people were willing to buy it anymore, so it turned back from this level. It came back down to the $60,000 level. Why did it move back up from here? Because this is a support zone. For the friends watching this video who already have more technical data than others, well, I'm creating a new perspective for you guys. So this video can be useful for you too. Even if you already know what support and resistance are, the examples I'm giving here can still be incredibly beneficial for your trading strategy. And you'll have to please be patient and bear with me during some parts of the video, because many people watching this at the same time might have absolutely no prior experience with market data at all. And I have to explain it thoroughly so that viewers from all different backgrounds and skill levels can use this video effectively. Well, we said either they no longer have the urgency to buy at resistance or higher prices were attractive to sellers. Look, someone bought at $20,000, $30,000, $40,000, $70,000 was attractive for them to sell. So the price goes up to a certain point. Look, the first stage is either there are no more buyers, no urgency to buy, or higher prices are attractive to sellers. Meaning so much new supply is entering the market that it's covering all the demand. And people who entered long positions from the bottom, people who bought at every stage along this path towards a resistance, which is why these candles are turning green and going up. These people take profits or exit the trade, meaning they exit either part or all of the trade at that resistance level, which creates a resistance level. At the support level, it's exactly the opposite, guys. I don't think there's a need for me to actually explain it. Let's go to the chart. Let me just show you an example. I'll go ahead and delete all of these lines that we had drawn just a bit earlier. The price is currently steadily climbing higher. Am I right? The corrections that occur, and at some point, the trend completely changes. So right here, I can say the uptrend is turning into a downtrend. This is the peak that reversed the trend. Now, we'll learn, guys, that every single one of these swing highs and lows we see along the way, each one is considered a support or resistance level. But my primary and most significant support and resistance in this 4-hour time frame, what I'm really saying is that these might be the crucial areas of interest in a much lower time frame. For instance, our playing field in the 15-minute time frame could be this specific area. But if I'm looking for a playing field in the 4-hour chart time frame to find those major support and resistance levels, the primary key levels I'm after, I really need to look for specific levels that demonstrate the ability to significantly reverse the price trend. I can give you these same explanations right here on the chart as well. Pay attention, it's just like that dollar example again. Don't worry about the current price at all. At one point, the price came and broke through a level. Where is it? 2.61. It went up, for example. The next time it hit this level, it moved back up from here. So suppose the dollar is at 60,000 tomans. The dollar went up to 70, dropped to 60,000, and then went back up to, say, 80. The next time the dollar hit 60,000, there's demand in this range. That's only natural. So when I see a bottom that's reversed the trend once, that becomes a key bottom for me. I'll draw a line here, and it becomes a support level. As for my other key resistance levels, I have one here that reversed the price movement again, and I have another one right here. These are my main support and resistance levels in the 4-hour time frame. But is this a support zone or not? It is here too. Right? But this specific support level is one I definitely look to trade in the 15-minute time frame, guys, and certainly not on the 4-hour chart. We'll get into this in much more detail later on, and you'll learn exactly why I say this isn't a support level I'd ever trade on the 4-hour chart. It's actually a support level that, when you look at the 15-minute chart, offers a completely different perspective for our entry. A trade. Why am I saying this? I'll go up one step in my time frame, meaning from 4-hour to weekly. If we're going to work with 2 time frames throughout the course, it's weekly with 4-hour, daily in 1 hour, and 4-hour and 15-minute. So if I consider a higher time frame to be 4 hours, I trade the support and resistance levels I identify in the 4-hour on the 15-minute chart. I trade the support and resistance levels I identify on the daily in the 1 hour, and my weekly support and resistance levels in the 4-hour. Now, what I showed you on the 4-hour chart, so you'd learn why, for example, when the price hits this level, it happens again next time, was just so you could see it. But if I want to draw this to see the playing field in the 4-hour, I'll go to the weekly time frame. I'm going to clear all of these now. Let's speed this part up in editing, so you don't have to wait. Okay. I'm going to the weekly time frame. I'll draw every single swing high and low. I'll teach you what swing highs and lows actually are. Swing high, swing low. And here's another swing high. Guys, I just need to identify the swing highs and lows of the weekly time frame to get the major 4-hour support and resistance. I don't need to sit and see which low or high actually changed the trend anymore. Did this high change the trend on the weekly too? No. On the weekly, it just did a pullback from this high. Where does the trend change? Where this low breaks. Now, you'll learn the definition of a trend in the next sessions. So if some things are unclear, you need to practice what I'm telling you so much that as we move forward, some of your questions will naturally be resolved. I think 20 minutes have passed since we started. We'll continue for 10 more minutes at most, guys, so the video doesn't exceed 30 minutes. Wherever we get to, we'll do the rest in the next session. We have something called polarity change. It doesn't need much explanation. A resistance that's broken turns into support, and a support that's broken turns into resistance. I'll tell you what the deal is now. Let's see it on the chart too. A support that turns into resistance, for example. I had a support here in this same time frame. It breaks and turns into resistance. See? Let's look at the 4-hour time frame, for instance. I had a support zone here that the price hit several times. Right? After breaking this area, it turns into a resistance. Now let's find a resistance that is turned into support. For example, here. It's a resistance zone, guys. It hit once and went back down. Hit and dropped, hit and dropped, hit and dropped. When it breaks, as the price pulls back to it, it turns into a support. Look, this resistance, now every time the price hits this level, it goes up. It pumps. It jumps from here. Why? Because it was a resistance zone that is now turned into a support. In support and resistance levels, in whatever time frame I work, what is a priority for me are my latest supports and resistances, which we obtain based on the swing high and low. For example, I want to work in the 4-hour and 15-minute time frames, meaning I want to draw the 15-minute supports and resistances on the 4-hour chart, just like I showed you for the weekly and 4-hour, and then go to the 15-minute to look for my trade. In the 4-hour time frame, I'm now going to identify my swing highs and lows. Look, my latest swing, high and low, and one that is this same low I had in the weekly as well. The upper level is more accurate, right? Okay. Now I'll go to the 15-minute. I have another one here, which is my support level. You see, I've drawn the 4-hour swing lows and highs. Now, when I go to the 15-minute, it clearly shows me the supports and resistances I can trade on in this time frame. Now, what has happened in this time frame? I had a support here, right? When it breaks, it turns into a resistance for me, which then breaks this resistance. Now, when this resistance is broken, it turns back into a support. It pulls back to it, and the price moves from here. See? This resistance breaks, and the price turns into a support. Now, I have a support, and a resistance has formed for me here. Let me make it logical in the 15-minute. Look, we drew it in the 4-hour. I'll get a bit more precise here. Now, you'll learn how to draw it later on. It's very simple. Look, instead of drawing a level, I've now drawn a zone, because when I came from the 4-hour to the 15-minute, I saw that this zone turns out to be more logical for me. Well, a resistance has been created for me. A zone has been created for me as a resistance zone. Now, when it breaks, it turns back into a support. Well, we talked about this. Supports is a zone where demand overcomes supply, slowing down or stopping the downward movement. If an area slows down or stops an upward movement, we call it a resistance zone. What do I mean by a swing high? The point where an upward price trend reverses direction. To any candle where, guys, the candles before and after it, each of these, what is it? Our chart that we're looking at is made up of a series of candles. For those who don't know the concept of a candle yet, look, we call these candles. The green ones are bullish, the red ones are bearish. You'll learn more about the details later on if you don't know them. Most of you already know this. Any candle whose low is lower than the lows of the two candles before and after it meaning the lowest point of the candle, the lowest point of the shadow under the candle is lower than the candles before and after it, lower than the lowest point of the candles before and after it. We call it a swing low. Now this candle is a swing low candle. SW, this candle is a swing high candle. Why? Because look right here. Look at the top of my candle. Look at the high of my candle. It's higher than the high or the top of the candles before and after it. I call it a swing high candle. Each of these, this is a swing low candle again. This is a swing high. In the 4-hour time frame, when I identify my swing high and swing low candles and draw lines on them, it's as if I've identified my main support and resistance levels for the 15-minute time frame. Okay? So if I want to draw the support and resistance levels that I'll be working with in the 15-minute time frame, and then go to the 15-minute time frame as my trading time, which you'll learn later which one is better to use and which one suits your personality better. If we're trading on the 15-minute, it's enough to identify my swing highs and lows on the 4-hour. Here's a swing low, here's a swing high, here's a swing low, here's a swing high, swing low. See? These swing highs and lows can define the support and resistance levels for my lower time frames. Now I'll go back. So what was a swing low again? A candle where the candles before and after it have higher lows compared to it. A swing high is a candle where the candles before and after it, one candle before and one candle after, have lower highs compared to its high. I call that a high. It's very simple. But in in-person courses, guys, I've seen that many of our friends sometimes had trouble with this. So since this isn't an in-person class and we can't practice together and I can't personally check everyone's progress, you have to seek out practice on your own. Or, for example, watch the video again. I'll identify a few of them now. Then you can go and keep doing it yourself to understand. Now, I have a swing high here. This is it. See, its peak is a little bit higher than the previous one. And it's completely higher than the next peak as well. So I call this candle the swing high candle. I'll zoom in and show you a swing low again. Where's the bottom of this candle? Right here. Right. Let me just draw it. The bottom of this candle is right here, right? Where's the bottom of the previous candle? It's higher than this one. Where's the bottom of the next candle? It's also higher than this one. So I call this candle the swing low candle. Now, when I want to draw a support and resistance, I can use any part of this swing low candle. This entire swing low candle can be a support or resistance zone for me, meaning I could include the whole thing, which is completely wrong here. Or I can consider a part of its shadow or body. See, I can consider this. Now, this is more logical. If I were to draw this swing low candle as a zone, using it to plot a support and resistance area, I should draw it like this. And as I move forward, I see that this support formed here, this resistance shown to it to this level. I could have even found it earlier from this swing low candle. We hadn't checked the past, guys. I just randomly said, okay, I'll show you a swing low candle. I can draw a level with it here. Why did I bring this level all the way here? Because I don't need to. This zone is covering 1, 2, 3, 4, 5, 6, a lot of candles. Okay? Whether I move this up or down, it still covers the same number of lows. So I drew it in a way that covers more lows compared to the default state. If I were to just, for example, make it like this and take the whole candle, what advantage would that give me? Other than giving me a uselessly large zone. But when I come here, 1, 2, 3, 4, 5. If I bring it lower, it's not logical here. Why? Because I just need to move this up a little bit to get 2, 3, 4 new lows. 4 more shadows would have hit this zone, and when I draw it this way, since it covers more areas, meaning more lows, as I move forward, I see that yes, it reacts to this here as well. If I had just come here and drawn a line, how would that have helped me? Not at all. That was just a line, right? Instead of drawing a zone, I would have drawn a line for this swing low. It would come here, get close to it, and then bounce back up. I'd say, oh man, it got so close to my entry zone, but I didn't get into the trade. So sometimes, or most of the time, it's better for me to define a zone. To draw a zone, I can use the swing lows and swing highs, or the entire body and shadow of those high and low candles, or I can use a portion of the shadow of the swing low and high candles. Depending on how much larger I should make that zone so that it covers more zones, more touches in the past. Of course, in the past, because I'm looking at the past when I want to draw a new resistance or a new support. To include more touches, I'll go ahead and enlarge my zone. I don't just make it big for no reason, which would be useless, nor do I make it so small that it covers very few touches. If I were to draw it now based on current conditions, I'd say, okay, this is my support zone. Okay, but why is this my support level? This is my lowest point. Or even if I just want to consider the shadow of this candle, my zone would be this. But why not bring my zone down to this point here so that it includes more of the lows in this area? That way I can capture a broader range of those lower values, which could be helpful. Or to here, this of course is more logical. It's including 1, 2, 3, 4, 5, 6, 7, 8 touches. So if I want to draw a major support zone, I'll consider this entire area. Next time, if the price comes down, this zone is important to me, or the breakout of this zone is significant. What about below it? Again, if I want to draw a zone, instead of it being a level, I'll draw this zone to include all these swing low shadows that I have here. The past is less important to me, meaning I won't enlarge it just to catch this one. But here, at this low, I'll try to have my zone include all of these shadows. Now I have a proper zone. Now I have a good playing field. If I want to draw it from my high as well, it would look like this. Now, on the 15-minute chart, these are the areas where traders make their decisions. These are the zones where I look for a trade based on certain data, based on some analysis of money flow, analysis of whale movements, and the market's wealthy players, which then becomes a matter of our own group strategy. So we won't go that far. We're just going to go through technical analysis and price action together. Let me go to this section. We've gone 4 or 5 minutes past the 30-minute mark. Okay, I've shown you how to draw support and resistance zones on the chart. A swing high or low might consist of several candles, meaning 2 candles could have identical lows, and together, relative to the 2 candles before and after them, they form a swing low. So it's possible, for example, let's look here on the chart. For instance, if this candle's shadow reached here, instead of going lower, its shadow was exactly the same length as the previous candles. Exactly the same. These 2 together would have formed the swing low. Since it formed a lower low on its own, it's considered the swing low candle by itself. But if it were like this, since the lows of the 2 candles before and after these 2 were higher, the 2 together would be my swing low candle. Let me see if I can find something like that. It's quite rare to find. Now here again, this is a swing high. If these 2 shadows were identical, they would both be the swing high. I don't usually look for something just to have it ready to show you. I try to let you see what I'm actually doing in practice with what I'm teaching. And I dislike having pre-prepared examples for you. Ready-made examples mean I don't even know my own style. It's like someone else told me what to say, or there's no real style. And I'm just looking for examples that worked and then preparing them. Usually, instructors are like this. They prepare something and know beforehand which examples to show, so they don't look bad. Like saying, okay, this was supposed to be resistance, and then it isn't. But we, overall, even if such a thing happens, aren't afraid of being wrong in the market, because we understand the market's nature and know our analysis won't always be right. Instead, we usually act based on what's most likely to happen. Well, I won't take up any more of your time. If you found this interesting, guys, please support this video with your likes and valuable comments so we're motivated to provide the next sessions for you. Minimize your losses and be successful.